Hello everyone and welcome to the Nomad Hedge. In today's video we're going to review the week in the stock market and briefly go through what we can expect the week ahead. But first, if you're new here, consider subscribing to this channel and hit the like button if you're enjoying the content in this video. So we saw that the Nasdaq closed up 8.8% for the week, which was the strongest gainer, followed by the S&P 500 which closed 6%, and then the Russell 2000 at 4.6%, and lastly the Dow was up 4%. Now the Dow lagged a little bit this week, but it was obviously the best performer weeks before, so that was not so much of a surprise to see this one slowing down a little bit in momentum. Let's also take a look at the S&P 500 sectors, and as we can see here, technology was the best performer, up 10%, followed by communication sector up 9.4%. We also saw some good performance from the financials, up almost 6% for the week, and then we had some laggers here from the utilities, healthcare, and energy. The crypto market was heavily down this week and was compounded with the collapse and bankruptcy of FTX, which saw liquidation of their FTT token and sent other crypto assets lower. Solana lost heavily, falling nearly 60% this week, along with other crypto assets such as Algorand and Avalanche, which saw similar declines. Ripple, ETH, and Bitcoin fell more than 20%, and they're now down respectively more than 70% year to date. FTX FTT token fell from an all-time high of $85 back in September 2021 to less than $2 today. Here's the daily chart of Solana, which shows its downtrend is still intact. What's interesting is that Solana has continuously failed to participate in previous bear market rallies and fell short to hold steady gains. Let's begin reviewing the market by taking a look at the CPI report released on Thursday, which came in lower than expected at 7.7% versus prior month's reading at 8.2%. This marks the slowest increase since January. More importantly for the Fed, however, is the core CPI, which excludes food and energy. The core increased 0.3% from prior month's 0.6% in September. Year over year, the core CPI increased 6.3% versus 6.6% in September. So because of this, stocks surged, treasury yields dropped, and the US dollar rolled over. The hope now is that this downward inflation trend continues. However, as 1 month doesn't make a trend, the market learned from this after the downside surprise in August, which saw a reversal in the months ahead. So for now, just treat this as a start of a potential trend. There are indications out there that this could be start of a new downtrend for inflation, and it could also persist. Some indications out there include sharply lower consumer demand, ease of supply shortages, and we're seeing large retail inventories with downward pressure in goods inflation. On top of this, we're also seeing declines for used cars, household furnishing, apparel, and consumer electronics. Although we did see an increase in housing inflation, which represents 1/3 of CPI, but that was mainly driven by rising wholesale rates. Rental prices, however, slowed for the first time in 4 months. Elsewhere, medical care services and airfare also dropped in October, and what could be somewhat of good news is that food inflation posted its smallest monthly gain since December of 2021. Now hopefully, this could spell a top for rising food inflation. Outside of that, gasoline prices increased after 3 months of declines, but was offset by declines in natural gas. In the months ahead, look out for reduced demand in commodities due to China's relaxation of COVID-19 rules. So this leads us to look forward to a Fed pivot. And in the eyes of the Fed, a deceleration in prices is obviously a welcome development, with potential slowdown in pace of rate hikes starting next month. A slowdown to 0.5% in December seems therefore plausible, but a higher for longer policy remains intact for now. Fed officials want to see a continuation of a downward trend in inflation for months ahead. Only then can we see a pause in Fed rate hikes. Interest rates expectations will shift once these inflation numbers comes down, along with a slowdown in tightness in the jobs market. The Fed previously has said it sees the terminal rate at 4.75 to 5%, which is most likely going to be reached by the next half of next year. So a pause in rate hikes seems in sight, but a complete Fed pivot with rate cuts and QE seems unlikely in the near and intermediate term, or at least through the rest of 2023 until they are convinced inflation goals has been reached. The Fed's focus is to bring inflation down to a target of 2%. As rates will continue to increase, the overall economy is likely going to slow further, with earnings expectations revised lower. Layoffs announcements are also set to increase because of this. Other than that, rest of the week's economic data were in line with consensus. One exception was the release of the University of Michigan's preliminary gauge of November consumer sentiment, which fell to its lowest level since July. Also, Tuesday's midterm election results weighed somewhat on the markets, with investors favoring a divided Congress that would limit new spending and regulations. The week ahead will feature some economic data and geopolitical events. President Biden will meet with China's President Xi Jinping in the G20 summit in Indonesia. They're most likely going to discuss tensions over Taiwan, Russia-Ukraine war, and the ongoing US tariffs on China, and more recent ship equipment restrictions. On the data front, the Producer Price Index, or PPI, for October is scheduled to be released Thursday, November 15th. Consensus PPI is forecasted to come lower to 8.3% versus September's 8.5%. Core PPI should hold flat at 7.2%. If October PPI numbers come in hotter than expected, we could see some of that dead cat rally to give up some gains. If otherwise, we might have to look at technical indicators if the market still have some upside potential short term. Retail sales comes out on Wednesday, November 16th, and existing home sales on Friday. On the earnings front, we're going to start seeing a final drawdown of corporate earnings with upcoming published reports from retailers such as Walmart, Target, Macy's, Home Depot, and Lowe's. Okay, that was it for today's video with a quick recap of the market last week and what we can expect the week ahead. If you haven't already, consider subscribing to this channel and hit the like button if you enjoyed the content in this video. Thank you so much for watching, and I'll see you in the next one. Take care.